Welcome back to the channel. My name is Steven. I'm a pharmacist and I own 52 units of real estate. So I had a great question in the comments asking, can I explain examples of passive losses in terms of taxes? And I think you may explain this, but this can only be done once, not every year. So do you have to keep buying real estate and depreciate fully every year you choose? So kind of the first question, let's talk about that, is what are examples of passive losses? So when you own real estate, and you get real estate income, it's considered passive income. And typically, if you have a W-2 job like myself, that's considered active income. So I'm actively working the business. Let's say I get W-2, I'm a 1099, I own a business, that's active income. When I get real estate income, it's considered passive income. So typically, when you have passive income, with real estate, it comes with something called passive losses as well. So these are paper losses that you can claim, or it could be actual losses too, that you claim. And so to explain that, basically, unless you are a real estate professional status, I have a whole video talking about real estate professional status, but unless you qualify as real estate professional status, currently I do not qualify as real estate professional status. So my active income is separate from my passive income and passive losses. Right? So let me kind of explain that. So for real estate, you get passive losses. And how do you get passive losses? So you have something called depreciation. So depreciation, there's multiple forms of depreciation, which are passive losses. Essentially, they're one and the same. I'm probably going to use those terms interchangeably in this video, but passive losses and depreciation is when you have the value of a single family home. Let's just say I have $1 million single family home. There's the land and there's the structure. So let's just say for simplicity, the land is $500,000. And that means the structure is worth $500,000. How do you figure out how much the land costs? You can look on your tax bill every year that tell you how much is the land and how much is the value of the structure. So you take the value of the structure and you divide that by 27.5. And that's basically your depreciation that you can write off every year. So even though on your cash flowing real estate, for example, using the structure divided by 27.5, that's just written in the tax code, you might have some passive losses on your passive income. So it can wipe out all your cash flow. So you get that money tax free, but you might have some passive losses that carry forward, right? So that's for single family home. So you can take the structure value divided by 27.5. I think for commercial real estate, so like apartments, it's the same thing. Let's say you bought it for $1 million. You have $500,000 for the land, $500,000 for the structure. I think you take that $500,000, you divide it over, I think it's 39 years, I want to say. It might be shorter, but I don't know why I think it's 39. I should probably look it up. But anyways, conceptually, you take the structure value, divide by 27.5, and you can write that off against your passive income, and that can carry forward as a passive losses if you have too many losses, like for me, for example. So for me, I have a lot of passive losses because when I buy real estate, I renovate it, and renovation cost is also something that is considered passive losses, right? So let's just say my 26-unit apartment complex, I renovated, let's just say all 26 units. On average, it cost me $10,000 each for simplicity. And so I've spent $260,000 worth of renovation on the inside of the property. So typically, when you do this, you can take that $260,000 and you can do something called a bonus depreciation, which allows you to do 100% of the renovation costs in the first year, right? So the laws may change, but conceptually, you can do 100%, 80%, 60%, some sort of accelerated amount the first year that you do it. So if I spent $260,000 on renovation, and let's say I can bonus depreciate 100% of that, that's $260,000 of passive losses that I can use to offset my active income, assuming I qualify as a real estate professional status. That's how people pay zero income taxes, because they're a real estate professional status. Let's say you make $260,000 W-2 income, you qualify as a real estate professional status because your wife qualifies, and you have $260,000 in renovation costs that you're bonus depreciating 100% in year one. So that's how you have $260,000 of losses with $260,000 of active income. And basically, when you file your taxes, your taxable income is zero. So you'll get a nice check from Uncle Sam of, let's say, $130,000, assuming a 50% tax bracket. So that's how people pay zero in taxes and actually get a large refund back, thanks to real estate depreciation and combining that with real estate professional status. So for me, I don't qualify as real estate professional status. So let's just say I make $260,000 income. I put $260,000 of renovation in my apartment complex, and if I choose to bonus depreciate 100% of it, today, then that $260,000 of passive losses will just carry forward every year. So it just carries forward and carries forward. So it just carries forward and rolls forward until one year. Eventually, let's say after I'm married and I qualify for real estate professional status, I can roll over that $260,000 so that in the year I qualify for real estate professional status, it can wipe out my W-2 income. And that's probably what I'm going to do. And I'm going to share how it looks like when I do it, right? Maybe in a year or two after I'm married and, my future wife becomes part-time, becomes a realtor, right? So I want to document my journey for you guys so you can learn. But it carries forward, right? So for me, I do my own taxes on TurboTax, right? And you can do so many options. Like you can choose to bonus depreciate. Like it could be 100%, 80%, 60%. The laws are changing, but let's just say you can do 80% of it year one. The remaining 20% is depreciate over 5 years. So for me, because I'm not a real estate professional status right now, I just chose to depreciate my, let's just say $260,000. Let's just make it $250,000 for simplicity over the next 5 years. So that means that I get $50,000 in passive losses every year. If I don't use those passive losses, they carry forward every year, right? So for me, it's okay to do 100% bonus depreciation now, and then just use that to carry forward subsequently, even though you're not using it today, right? Or if you're okay, $50,000 a year for the next 5 years. So that's what's happening to me. I think I have about $300,000, $400,000 of passive losses because I renovated my 26-unit apartment complex, and those renovation costs are being depreciated over 5 years. I have my 20-unit apartment complex, which I renovated. I had my mobile home park, which I sold for a loss, right? So when you sell for a loss, it's now considered an active loss. So now that active loss can offset my active income. So when I lost $100,000 on my mobile home park, it offset my active income by $100,000. So I ended up getting about $40,000, $50,000 back from Uncle Sam, right? So, it sucks to lose money, but at least it was a tax write-off in a way. So passive losses is kind of the better way to write off your active income, assuming you qualify as real estate professional status, right? So what are examples of passive losses? So I went over the first one, which is the structure of your property divided by 27.5 years for single family residential, or it's 39 years for commercial. That's one form of passive losses. Another form is any renovation that you do in the interior of the property. So if I do the interior renovation of the property, it has a lifespan of 5 years. So if I spent $100,000 to renovate my inside units, then I can depreciate that over 5 years. So that's $20,000 a year. If you do fencing, landscaping, that can be depreciated over, I think, 10 or 15 years. I don't know, but when I do on TurboTax, you just categorize it and they'll tell you can this be 5 years? Can this be 10 years? Can this be 15 years? Or can I bonus depreciate all of it year one? Or you can even bonus depreciate 50% of it now, and whatever the remaining 50% is over 5 years, 10 years, 15 years. So in TurboTax, it just tells me. But I just know that because I did a lot of renovations on the inside, all that is depreciated over 5 years, or I can bonus depreciate it now, right? So that's how I can explain passive losses. Like I said, I'm carrying forward $300,000, $400,000 of passive losses over the past 3 years when I was renovating my apartment complex. So when I do qualify for real estate professional status, I can essentially wipe out my W-2 income, my wife's W-2 income, and we would probably get a fat check of $200,000 back from Uncle Sam. So that's when real estate becomes the most powerful, right? Especially multifamily real estate. It's really the passive losses that you can use to offset your active income, whether it's W-2, whether it's a business income, whether it's W-2 plus business income, and you qualify as real estate professional status. That's when it's really powerful, right? So that's what I'm trying to do. So for me, once I've used up all my passive losses, let's just say I used up my $400,000 of passive losses that I've been carrying forward every year, and now my W-2 income skyrocketed, my business income skyrocketed. Now at this point, I have to buy more real estate in order to have more passive losses, right? So I can either renovate my apartments again, right? But they're already renovated. So I'm forced, if I want to maximize the tax benefits, forced to buy more real estate, right? And then you can do something called a cost segregation study or analysis. So typically you buy a house and you have to pay a company to do a cost segregation study. And typically you can then accelerate items of depreciation, right? And I think on a rule of thumb, I want to say it's about 30% of the value of the property you're buying. So let's just say I bought $1 million house. If I do a cost segregation study, on average, I could probably write off today $300,000. Right, so $300,000 can be write off today, and the remaining $700,000 is, basically depreciate over 27 and a half years. So if my W-2 income is $300,000, right, and then I buy a piece of real estate for $1 million, and after doing the cost segregation study, I can write off $30,000. Then I can wipe out my $300,000 W-2 income, get about $150,000, about 50% back from Uncle Sam when I file taxes. And so every year I'm forced to buy, assuming I make $30,000 a year, I'm forced to buy $1 million property every year. So that's when, you see a lot of people buying real estate. And, don't get me wrong, that's the best way to maximize your taxes, right? Like if I make $300K, I buy $1 million property that I cost seg, every year for $300,000, I essentially pay no money. So it becomes like an infinite loop, right? Where let's just say I make $300K, I buy $1 million property that maybe cash flows or breaks even. Let's just say it breaks even. That's probably more realistic, right? And then I can write off $300K. I file taxes. I get back a tax refund of $150,000 from Uncle Sam. I use $150,000 to buy another piece of real estate, right? So the cycle continues, but that's when you're kind of this hedonic treadmill of constantly buying real estate, and it never ends and never ends and it never ends. So for me, my strategy would be, while I'm working at W-2, if my business is doing well, I'll buy real estate to wipe out my W-2 income. But when I hit the point where I don't want to work anymore, maybe I want to take it back on my business or whatever that looks like, at that point, maybe I'm not forced to buy real estate, right? Because I am more of a lifestyle investor and I'm building wealth to give me freedom, and I don't want to be a slave to my real estate either. Right? So it's a fine balance, but while I'm actively W-2, it makes sense for me to, while I'm W-2, my fiance is part-time W-2, to buy real estate and utilize real estate professional status, use those passive losses through the structure over 27 and a half years, through renovations over 5 years, using bonus depreciation if I want to accelerate that, and doing cost segregation study if I bought new real estate, right? So those are the ways that people pay zero in taxes. And honestly, if I can get, let's just say $100,000 check from Uncle Sam, that's way more than any cash flow you'll get from any real estate, right? Like $150,000 divided by 12 is about, what is that, $12,000 a year in cash flow? Like, how much real estate could you buy in year one get you $12,000 a month in cash flow, right? That's the power of depreciation, the power of passive losses, and combining that with real estate professional status, where you're wiping out your active income from your W-2 and from your business, right? So that's the true benefit of real estate. Year one is depreciation, passive losses. The future benefit of real estate is principal pay down, right? Over time, the principal gets paid down. Over time, it will appreciate. Over time, the rents will go up. So over time, there'll be market appreciation. You can do forced appreciation as well. So that's kind of the long game of real estate, right? Is you want those tax benefits now and immediate, and then within 10 years, your rents will go up, your loan will get paid down, and the value will go up. That's the long-term game of real estate, combined with the short-term. So that's why you need, real estate professional status, right? To really maximize the benefit of real estate. So anyways, let me know if you have any questions. Love to answer your questions. If you want to learn how to buy multifamily real estate and take advantage of depreciation and passive losses, check out the mentorship program down below. Otherwise, please like, comment, subscribe, and hope to see you in the next one. Thank you so much.